Hi, today I will be teaching you more about the topic of financial ratios. And by the end of this video, you should know the most important and widely used financial ratios, what they measure exactly, and how you can make investment decisions based on them. And I've personally chosen to explain more about this topic in particular because I think that financial ratios are essential if you want to analyze a company fundamentally, because they show you the financial health of a company and they give you points of confluence. And if you have enough points of confluence, you can make a very educated investment decision. And with that, you don't make a mere bet on a company, but you have an investment decision that's supported by a great and very strong rationale and good arguments. For example, if you analyze a company fundamentally based on 20 different financial ratios and 18 of them give a positive signal, you have a lot of conviction in your arguments because you have a lot of points of confluence and yeah, you have a lot of arguments that the company will be performing well in the future. So in this video, I will be talking about the five financial ratios that I personally find most important in fundamental analysis. Well, let's go into the first one. That's the PE ratio, or the price to earnings ratio. And this is a ratio that compares a company's share price to its earnings per share. So it divides the share price by the earnings per share. So essentially, it measures how much investors are willing to pay for $1 of profit. And this is also quite useful in assessing sentiment because if people are willing to pay a lot for a dollar profit, there's probably quite a lot of hype around the stock. But is that justifiable? Well, that's the question that depends on many things. For example, a high P ratio could mean a number of things that are actually quite the opposite of each other. It could mean that a company is overvalued because the general consensus is that the average PE ratio of a company is between 20 and 25. So, yeah, if it's a lot higher than that, the company would be overvalued. But it's not as simple as that because it could also mean that investors anticipate great future growth. For example, if you look at 10 years ago, companies like Tesla, companies like Amazon, they had very high PE ratios. Amazon was around 75, 80. Tesla was in the hundreds, I think 600 at the highest point. But were those companies overvalued back then? Well, most definitely not. Tesla has increased by about 3,000%, Amazon by 700%. So you need something to normalize the PE ratio with. And that's where the PEG, or the price earnings to growth ratio, comes in. And this divides the PE ratio by the EPS, earnings per share, growth rate. So for example, if a company is currently trading at $100 and last year's EPS was $4, this year's EPS is $5, the PE ratio of that company would be 100 divided by 5, so 20. And the EPS growth would be 25% because it went from 4 last year to 5 this year, so that's 25%. So the PEG ratio would be 20 divided by 25 is 0.8. Generally speaking, a PEG ratio of roughly, around 1 is considered to be fairly valued. Higher would be overvalued, lower would be considered undervalued. So this company would be fairly valued, but probably leaning a little bit towards being undervalued. The next ratio I want to talk about is the PB ratio, the price to book ratio. And this is, well, a ratio that compares a company's market value to its book value. So it divides the market value by the book value. The market value of a company is simply the market capitalization of the company. And the book value is basically the equity that you see on the balance sheet of a company. So the assets minus the liabilities. So for example, if a company's market cap is $100 billion and it has 400 billion in assets and 350 billion in liabilities, the PB ratio would be 100 billion divided by 50 billion. So this company would be worth twice the book value. There's not really a good rule of thumb for what a good PB ratio is, but generally speaking, one below 1 is considered to be a great opportunity for value investors. But this is quite uncommon because most companies trade for more than its book value. And usually, if you want to explain book value, you also look at another financial ratio, which is called return on equity. And this is the net profit of the company divided by the total shareholders' equity. And the typical ROE, return on equity, really differs per industry and also per size of the company. So if you have calculated the ROE of a company, you really need to compare that to similar sized companies within the same industry to compare apples with apples. And if you, in that case, have an ROE that's a lot higher than that of other companies, this means that the company is really good at converting its own equity into profits. But it could also mean another thing. The company might be leveraged because leverage amplifies the return on equity. So that's why it's also very important to know the debt to equity ratio of a company. So this is the total debt divided by the total equity of a company, and also this should be compared to similar sized companies in the same industry to get a feeling for just how leveraged a company really is. Because if a company is very levered, the high ROE is probably not due to great profitability or great efficiency, but it's probably due to leverage, which could mean a very volatile and a very risky investment. So knowing all of these and calculating all of these financial ratios is really important if you want to judge whether a company is a good investment. You shouldn't look at one, you should combine a lot of them together. And understanding these ratios is not going to make you Warren Buffett overnight. It's not going to make you rich immediately, but it will give you a very solid foundation and one that gives you the ability to distinguish hype from reality and just back up your decisions, support your decisions with solid arguments. So I would encourage you to keep practicing, use them to your advantage, and I wish you the best of luck in your investment endeavors. And well, thanks for watching. And see you next time.